what if I told you that a single corporate maneuver just revealed a hidden asset worth a staggering $10 billion? And what if I said that this one revelation sent an airline stock soaring over 12% in just one trading session, hitting levels we literally haven't seen since before the pandemic? Well, welcome back, everyone, to today's Explainer. I am thrilled you're here because today we're talking about Air Canada, ticker symbol AC on the TSX. We're going to break down this massive Aeroplan stake sale, untangle some, frankly, pretty mixed signals from their latest earnings report, and finally look at exactly where top financial analysts see this stock heading over the next 12 months. If you're a focused learner tracking market catalysts, or just keeping a close eye on the airline sector, you are in the exact right place. Okay, let's dive into this. You know, the catalyst for this massive 12% stock surge, it actually has nothing to do with selling more plane tickets or launching new flight routes. The headline event that completely woke the market up revolves entirely around Air Canada's loyalty program, Aeroplan. Late last week, the airline dropped a major announcement. They're selling a minority stake in the Aeroplan business to a powerhouse investor group. We're talking about private equity giant Blackstone teaming up with Quebec's massive pension fund manager, the CDPQ. But to really get why the stock chart basically went vertical, we have to look closely at the math behind this specific deal. Section 1. The Aeroplan deal unpacked. And this brilliantly illustrates the new reality of the Aeroplan business. See, Air Canada is not giving up control here, not at all. They're keeping a dominant 75% ownership of their highly coveted points program. What they've done instead is carve out a 25% minority slice, which now goes to Blackstone and CDPQ. Now look, selling a piece of your loyalty program isn't a totally brand new concept in the airline industry. But the absolute jaw-dropping part of this announcement is what those investors were actually willing to pay for that 25% slice. They paid 2.5 billion Canadian dollars. So let's do the math here together because this is the crucial point. If a 25% slice of the Aeroplan business is worth $2.5 billion, well, that means the open market is effectively valuing the entire loyalty program at a staggering $10 billion. Now, why is that $10 billion number such a huge deal? Well, before this news hit the wires, Air Canada's entire market capitalization, meaning the value of the whole company, the planes, the routes, the brand, everything, was sitting at roughly $11 billion. This deal suddenly revealed that the loyalty points business alone is valued almost as highly as the entire airline operation itself. It's wild, right? It just proves what we see globally. Top-tier airline loyalty programs are absolute cash flow machines. The market simply hadn't priced in just how incredibly valuable Aeroplan was until Blackstone and CDPQ actually wrote the check. So, the very next question you're probably asking is, what exactly is Air Canada doing with all this new cash? Well, management isn't just sitting on it, that's for sure. They're deploying it strategically in two major steps. Step 1 is all about aggressively de-risking the balance sheet. They're paying down a massive $1.2 billion bond maturity. This instantly cuts down their ongoing interest expenses and really strengthens their overall financial footing. But step 2? This is where things get really exciting if you're a shareholder. They are launching an accelerated share repurchase program to buy back up to 800 million Canadian dollars of their own stock. By reducing the total number of shares out there, it naturally boosts the earnings per share for everyone still holding the stock. Honestly, it's a wildly bullish signal from management, basically shouting, "We believe our stock is fundamentally undervalued." Section 2. Record revenue versus rising costs. Now, what's really interesting about this slide is the deliberate contrast in the two realities Air Canada is currently operating in. On one hand, we have some incredible news. Record operating revenues of $6.3 billion in the latest quarter. That's a fantastic 11% jump year over year. Canadians are definitely still traveling, and that highly lucrative corporate travel segment, it's making a very strong comeback. In fact, if you strip out one-time items, they handily beat analyst expectations on adjusted earnings. But here's the catch. Despite selling $6.3 billion in tickets, the company still reported a net loss of $178 million for the quarter. So you've got to wonder, how does a company pull in record-breaking revenue but still end up losing money? Well, the culprits behind that net loss really come down to two major factors. First and foremost, fuel. Thanks to recent geopolitical tensions, jet fuel prices spiked pretty significantly during the quarter. That volatility alone ended up costing Air Canada an extra $500 to $600 million in just that single quarter. It is a massive, uncontrollable expense. And you know, it wasn't just fuel weighing them down. Labor costs are also up significantly because of newly ratified long-term contracts with their pilots and crew. So the reality on the ground is quite stark. While they're successfully carrying more passengers than ever and hitting absolute record revenues, a massive chunk of that incoming cash is quite literally being burned up in the jet engines and paid out in new payroll agreements. Section 3. What Bay Street analysts say. Following the Aeroplan announcement, we saw an overwhelmingly bullish wave of upgrades rolling in from the top banks in Canada. Scotiabank upgraded the stock, bumping their target up to $33.50. But BMO Capital Markets and RBC Capital, they took an even more aggressive stance, both pushing their price targets all the way up to $37 and reiterating strong outperform ratings. Now, if you average out the street right now, the general consensus sits at a moderate buy. But those $37 targets from BMO and RBC are absolutely crucial to note. Why? Because they suggest there is still massive upside potential from current trading levels, provided management can actually execute their strategy properly over the next few quarters. So you might be thinking, why are these institutional analysts staying so incredibly bullish despite that $178 million net loss we just talked about? Well, it's because they firmly believe that these current operational cost pressures are largely temporary. More importantly, Air Canada's management has explicitly come out and stated they expect to completely offset 100% of those incremental fuel costs by the end of the year. They are actually projecting that moving forward, unit costs will rise at a slower pace than general inflation. Basically, the analysts are betting that the airline is going to get its operational costs back under tight control, which would finally allow that record $6.3 billion revenue engine to flow straight down to the bottom line. Section 4. The final verdict and risks. Everything we've covered today really distills down into an ultimate balancing act. Let's look at it. The bull case is incredibly strong. I mean, the Aeroplan transaction is honestly a masterstroke. It fundamentally de-risks their balance sheet and gives them the financial firepower to execute those significant share buybacks. Combine that with a modernized, fuel-efficient fleet and very strong travel demand heading into the fall, and Air Canada has a wonderfully clear runway to record profitability. But the risks, they are definitely undeniable, and frankly, mostly out of the airline's control. The macro environment remains super volatile. If global tensions cause oil prices to wildly spike again, boom, it immediately hits the bottom line, no matter how packed those planes are. On top of that, airlines are historically hypersensitive to economic downturns. If the broader economy dips into a true recession, that highly lucrative corporate travel and even everyday leisure travel could cool off very, very quickly. So the bottom line here is that Air Canada is a fascinating turnaround story that is undeniably gaining some serious, tangible momentum. This strategic Aeroplan deal gives them massive financial flexibility, while strong consumer demand provides an excellent revenue tailwind. For those of you looking at a mid to long-term horizon, those $37 analyst targets definitely suggest the stock still has some runway left, assuming, of course, that fuel costs don't completely derail the train. But now I want to turn it over to you. Looking at this brilliant $10 billion loyalty program reveal and balancing it against those rising operational costs, what do you think? Is Air Canada a buy at these current levels, or are you waiting around for a broader market pullback? Take a good look at the data we've organized here today, continue your own research, and let that question guide your next steps. Thanks so much for joining me for this explainer, and I'll see you in the next one.